Ladies and gentlemen, good day and welcome to the Axis Bank conference call to discuss the bank's financial results for the quarter ended 31st December 2024. Participation in the conference call is by invitation only. Axis Bank reserves the right to block access to any person to whom an invitation has not been sent. Unauthorized dissemination of the contents or the proceeding of the call is strictly prohibited, and prior explicit permission and written approval of Axis Bank is imperative. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions at the end of the briefing session. Should you need assistance during the conference call, please signal an operator by pressing star and then zero on your touchtone phone. Please note that this conference is being recorded. On behalf of Axis Bank, I once again welcome all the participants to the conference call. On the call, we have Mr. Amitabh Chaudhry, MD and CEO, Mr. Rajiv Anand, Deputy Managing Director, and Mr. Puneet Sharma, CFO. I now hand the conference over to Mr. Amitabh Chaudhry, MD and CEO. Thank you, and over to you, sir.
Thank you so much. We have on the call other members of the leadership team. This quarter, we delivered healthy core operating performance. Our focus has been on profitable and sustainable growth. We continue to calibrate risk internally across portfolios and monitor the changing credit environment. Balance sheet and capital levels continue to remain strong. Let me summarize the third quarter operating performance. Core operating profit was up 14% year-on-year and 5% quarter-on-quarter, driven by healthy operating income growth and further moderation in operating expense growth. Business growth is slow this quarter on period-end basis, but we continue to grow deposits at a healthy pace of 13% year-on-year and 3% quarter-on-quarter on a quarterly average basis. Focus loan segments have also grown at a faster pace. Like small business, SME, and mid-corporate together grew at 16% year-on-year and 4% quarter-on-quarter. CASA ratio and fee to average assets continues to be the best amongst peer private banks. Consolidated ROA and ROE stood at 1.71% and 15.8%. The bank is well capitalized with a CET1 ratio now of 14.61% with net accretion of 49 basis points in quarter 3 financial year 25 and 87 basis points in 9 months financial year 25 period. We stayed focused on 3 core areas of execution of our GPS strategy, namely becoming a resilient all-weather franchise, creating multiplicative forces to build competitive advantage, and building for the future. I will now discuss each of these areas. Over the last few years, we have significantly progressed towards building a resilient all-weather franchise. There are 3 areas of focus as we navigate the current cycle: deposit quality and growth, retail asset quality and costs, where we need to work on sustainable outcomes. On retail asset quality, a normalization cycle is in progress. Our recognition and provisioning policies are perhaps the most conservative amongst Indian banks. We expect this will stabilize for the sector over the next few quarters. On the cost side, our expense growth this quarter has moderated to 1% year-on-year, as we had been indicating in our prior calls. Let me move to deposits now. The deposit journey for Axis Bank should be looked at from 3 aspects: quality, cost, and growth. Please refer to slide number 17. On the first 2 parameters, we have delivered well. We have improved the granularization in our deposit book, which positively impacts the quality of LCR deposits, consequently improving the outflow ratio by 320 basis points over the last 2 to 3 years, and is now similar to larger peer banks. We have also demonstrated controlled increase in cost of funds over the last 6 quarters, with only 3 basis points increase in the last 3 quarters. The above focus, along with macroeconomic factors, have impacted the period end growth in the last 1 year. However, quarterly average balance-based deposit growth remains higher than the industry at 13%. The quality and strength of our deposit franchise continues to improve through Project Triumph, the bank-wide deposit transformation program. Our acquisition engine, expansion plans, product launches, salary credits, Burgundy OEMs remain healthy. We will see the effects of all these efforts in the deposit growth as the impact of reduction in certain portfolios start to stabilize and tight liquidity scenario eases. We have opened 130 new branches in the last 3 months and 330 in the first 9 months of this fiscal. The new-to-bank acquisition engine for the savings franchise has trended well in this quarter. We saw savings new-to-bank deposits up 15% year-on-year, with new accounts opened up 2% year-on-year, and balances per account up 15% year-on-year. With a specific focus on the needs and requirements of women, the bank launched a special women's account Arise, a comprehensive offering with financial solutions and healthcare benefits. We believe there is significant market opportunity in this segment. The bank has made focused interventions to ensure that the salaried customers remain engaged with the bank. We see higher number of customers, both existing as well as newly acquired customers getting salary credits. We have seen 24% year-on-year growth in salary uploads in the new to the bank salary book by December 24. We have seen 42% year-on-year growth in premium acquisitions in new to the bank salary book by December 24. Premiumization of a franchise continues to progress strongly, led by 26% year-on-year growth in Burgundy assets under management. On the wholesale segment, please refer to slide 37. Our industry-leading customized solutions across liquidity management, payments, and collections continue to drive higher transaction banking flows, leading to better current account balances. We continue to garner several key recognitions for the capabilities and initiatives we have undertaken successfully in the last few years. Axis Bank won the Best Indian Bank at the prestigious Financial Times Bank of the Year 2024 awards, which is testimony to the quality and depth of its banking services across verticals. It received the IBSI Global FinTech Innovation Awards for the most innovative use of AI/ML, Best Digital Channel Platform Innovation, and Most Innovative Digital Onboarding Rollout. It also got the CX Asia Excellence Awards 2024 for Best Use of Intelligent Chatbot and Best Use of Data and Customer Insights. Axis Bank Foundation was awarded the prestigious Gold Award at FICCI's 4th Sustainable Agricultural Summit and Awards 2024. B, creating multiplicative forces to build competitive advantage. We continue to innovate and remain open to new partnerships and collaborations. During the quarter, GenWise, developed in collaboration with Axis Bank, India's leading app-based club for senior citizens, has launched an industry-first UPI payment solution specifically designed to address the needs of India's elderly population. International Finance Corporation, the soft loan window of the World Bank, has partnered with Axis Bank to provide $500 million loan to scale up green project financing in India. C, building for the future, our digital banking performance continues to remain strong. In this quarter, the bank launched new products, including a personal finance management tool, which is an industry first, the ability to see their investments in shares across brokers. Further, the bank made several enhancements to its product, including redesign of several journeys, new journeys such as opening FD via UPI, continued rollout of Neo for corporates and Neo for businesses, which are digital channels aimed at corporate and small business customers respectively. In quarter two, the bank successfully migrated erstwhile Citibank customers to Axis Bank digital platforms. Subsequently, digital activity of these customers has seen material improvement. We continue to work on bank-wide programs to build distinctiveness. Our bet on Bharat is growing from strength to strength. The rural advances grew 17% year-on-year, and deposits from Bharat branches were up 9%, thereby aiding the PSL metrics. We have expanded our multi-product distribution architecture to over 2,650 branches now, complemented by 62,000 strong CSC VLE network across 680 districts and 80+ partners across the country. Sparsh, our distinctive customer obsession program, continues pace. Sparsh simplifies interactions, driving NPS, automation, and digitization with a focus on customer loyalty and business growth. Our retail bank NPS score has matured significantly, rising to 148 plus from a baseline of 100 in the past 2 years. In closing, we are well placed in the current macro environment. We continue to closely monitor the geopolitical environment, inflation, liquidity, cost of funds, and its impact on our businesses. We will continue to invest where necessary to remain differentiated and distinctive in our journey towards building an all-weather institution. I will now request Puneet to take over.
Thank you, Amitabh. Our Q3FY25 core operating profit was up 14% year-on-year and 5% quarter-on-quarter. PAT was up 4% YOY. Our 9 months FY25 consolidated ROA at 1.8% and consolidated ROE at 16.9%. The reduction in consolidated ROE is attributable to reducing leverage on the balance sheet. The operating leverage aided a healthy core operating profit performance for us. Q3 FY25 net interest income grew 9% YOY. Net interest margin was 3.93%. Q3 FY25 fee income grew 6% YOY. Retail fee income grew 5% YOY. Granular fees was at 94% of total fee. Our operating profits grew 15% year-on-year. Operating expenses growth moderated to 1% year-on-year and declined 5% on a sequential quarter basis. Q3 FY25 consolidated ROA at 1.71% and consolidated ROE at 15.8%. Our 9 months FY25 operating profit was 31,353 crores, up 18% YOY. 9 months FY25 PAT at 19,256 crores, up 9% year on year. Focus on average deposits continues. CASA continues to be amongst the best in our large bank peer set. On a month-end balance basis, total deposits grew 9% year on year and 1% quarter on quarter. Term deposits grew 14% year on year, 3% quarter on quarter. CA grew 8% year on year, 1% quarter on quarter. SA was flat year on year. On a quarterly average balance basis, total deposits grew 13% year on year and 3% quarter on quarter. Term deposits grew 19% year on year, 5% quarter on quarter. Our average LCR for Q3 FY25 was 119%. Outflow rates improved by 60 basis points over the last 2 years. Loan growth delivered across focused business segments. Our net advances grew 9% year on year and 1% quarter on quarter. Retail loans grew 11% year on year, 1% quarter on quarter. SME grew 15% year on year, 3% quarter on quarter. Corporate loans gross of IBPCs sold grew 4% year on year. Small business banking loans grew 20% year on year and 4% quarter on quarter. Mid corporates book grew 15% year on year, 4% quarter on quarter. Small business banking plus SME plus mid corporate, which is our focus segments, the loan value stands at 2,30,055 crores, 22.7%, comprising 22.7% of loans, up 761 basis points in the last 4 years. We are well capitalized with a self-sustaining capital structure and adequate liquidity buffers. Our overall capital adequacy ratio stood at 17.01%, with a CET1 ratio of 14.61%. Net accretion to CET1 of 87 basis points in 9 months FY25, 49 basis points in Q3 FY25. We hold 5,012 crores of other provisions not considered for CAR tax computation, which provides us with an additional cushion of 38 basis points over reported capital adequacy. We have an excess SLR of 67,588 crores. We continue to maintain a strong position in payments and digital banking. We are amongst the largest players in merchant acquiring with a market share of 20% and an incremental market share of 27% in the last 1 year. Bank maintains its number 1 position in UPI payer PSP space with a market share of 30%. Open by Axis Bank remains amongst the world's top-rated mobile banking app on the Google Play Store and iOS App Store, with a rating of 4.7 and 4.8 respectively, with roughly 15 million monthly active users. Open by Axis Bank and Axis Pay have 14 million non-Axis customers, 29.3 million customers on WhatsApp banking. Our credit card SIF market share stands at 14% and retail card spends grew 11% year on year. Our asset quality has been stable. Gross NPA at 1.46%, declined 12 basis points year on year. Net NPA at 0.35%, flat year on year and quarter on quarter. Our PCR remains healthy at 76%. On an aggregated basis, our coverage ratio, which is defined as all provisions by gross NPA, stood at 151%. Our Q3 FY25 gross slippage ratio at 2.13%, net slippage ratio at 1.40%, and net credit cost at 0.80%. Key domestic subsidiaries delivered a strong performance for us. 9 months FY25 profit at 1,401 crores, up 26% YOY, with a return on investment on domestic subsidiaries of 49%. Axis Finance 9 months FY25 PAT grew 20% year on year to 509 crores. Asset quality metrics remain stable. ROE at 14.98% for Q3 FY25. Axis AMC 9 months FY25 PAT grew 27% year on year to 378 crores. Axis Securities 9 months FY25 PAT grew 86% year on year to 368 crores. Axis Capital 9 months FY25 PAT grew 36% year-on-year to 148 crores, and Axis Capital executed 43 ECM deals in the 9 months period. With that, we conclude opening comments. We'd be happy to take questions now.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone phone. An operator will take your name and announce your turn in the question queue. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Siddhi Nayak from Reuters. Please go ahead.
Hi, sir. I had two questions. My first question relates to the provisioning. Last quarter and this quarter, both we've seen quite a lot of jump in provisions. Want to understand from you, currently, do you see the need to, to make more provisions? How much, till what time or till what quarter is this trend expected to persist? If you could answer the first question, then I'll come to the second.
Thank you for the question. I don't think there's been a material movement in our provisions and contingencies line. The average, the provisions and contingencies to average assets over the last 3 quarters has stayed between 0.56% to 0.59%. So it's actually been very stable. Even in rupee crore terms, our provision and contingencies have been in the 2,000 to 2,200 crore range. So that number is not volatile but reasonably stable. Our provisions are largely towards the retail unsecured portfolio that has slipped given the current market environment. We've taken corrective actions on a look-forward basis on that portfolio. We continue to monitor those portfolios clearly as we get into Q4.
Okay. So at this stage, do you foresee the need to make more provisions? No.
We are in the credit business, so provisions would always be part of our operating expense. It's very difficult to be in a credit business and not have credit cost. We've previously indicated that across the industry, personal loans and credit cards as a portfolio have been seeing higher levels of risk than they historically ran. We are in the normalization of a credit cycle. Therefore, we continue to monitor those portfolios closely. We do not provide an outlook on future credit costs. Therefore, I can't tell you whether we will provide more or less in the next quarter.
Okay. So my second question is on your gross slippages. They have increased both QOQ and YOY. I wanted a breakup of how much of that is from microfinance and how much is from, say, credit cards and personal loans.
Thank you for the question again. We do provide a breakup of our gross slippages, but we do not do it at a product level. Our total gross slippages for the quarter was 5,432 crores. It is partially impacted by seasonality. You must remember that Q3 is seasonally heavy on slippage because we see agri slippages. The breakup of the 5,432 crores is as follows: 4,923 crores in retail, 215 crores in our CBG/SME business, and 294 crores in our wholesale business. While I have provided this data, my request is gross slippages may not be the most appropriate number to look at. We do have accounts that slip in the quarter and get upgraded. So net slippages may be a better number for you to look at, adjusted for recoveries and upgrades.
Okay, so thanks. I'll come back.
Thank you. The next question is from the line of Subrata Panda from Business Standard. Please go ahead.
Yeah, hi. My question was on loan growth. That was 9% YOY, but sequentially is 1%. So just wanted to understand, what is holding you back though? Is the CD ratio a concern, or why just 9% growth?
Subrat, hi, this is Subrat. One of the things we have always maintained is some of the growth numbers we should look not on a quarter-on-quarter basis, but also on a a slightly longer term basis. So if you take a 9 or a 12-month view of our loan growth, it's been good and it continues to trend in the in the range of the guidance that we have given about our advances growth. In this quarter, we've been a bit more careful about growth in some of the segments where we see some stress, and therefore we have calibrated our growth in those segments, and because of which we've taken some calls in terms of which segments to push and which segments to go easy on, which is the result of some of the some of the stress that we are seeing in particular sectors. So on a calibrated, deliberate basis, the growth in this quarter is about 9%. But we are fairly confident that on a yearly basis, we will continue to see good growth in our advances.
Right. And is that why the margins have also dropped slightly?
The margins drop is not linked to growth. The margin drop is broadly, we have a 6 basis points drop in margin. 3 basis points of that 6 basis points is attributable to higher interest reversals in quarter 3 compared to quarter 2, which is purely because of seasonality relating to the agri portfolio. And 3 basis points is attributable to the higher LCR that we have maintained through the quarter. Our average LCR last quarter was about 114-115%. Our average LCR this quarter is 119%. So those are the two factors that have contributed to the drop in net interest margin.
Thank you so much.
Thank you. The next question is from the line of Vishwanath Nair from NDTV Profit. Please go ahead.
Hi, good evening. Couple of questions. Firstly, on the retail, the comments that you made on the retail asset quality front, you said there's a normalization that is happening on the asset quality front. I wanted to understand, what does normalization mean to you? Are you suggesting that this is the peak and likely we are going to see it fall, considering that the slippage ratio has jumped about 35 basis points quarter on quarter? That's a significant jump. And the second part of the question is then, what are the corrective actions that you mentioned that Axis Bank is taking at this point of time? These are the only questions I have. Thank you.
Thank you for the question. What do we mean by normalization? Effectively, we've been coming off a trough in credit costs last fiscal to current fiscal. So last fiscal was not representative of through cycle credit cost. When we mean normalization, we mean a journey that is moving from trough to through cycle average. So that's what in our terminology we call as normalization. The reason we are calling this as a normalization is we are seeing increased risk in certain segments. We are also seeing that risk across segments pan market, so it's not Axis specific as such. And therefore, in our minds, it is normalization and not a full-blown credit cycle, because we've not exceeded our 15-year averages on gross credit cost or net credit cost as at quarter end. I think the other observation you made and our request is to look at the data slightly differently. While there has been an increase in gross slippages on a sequential quarter basis, quarter 2 and quarter 3 are not comparable. Quarter 1 and quarter 3 have better comparability because of the agriculture cycle. You see agri NPAs flow through in quarter 1 and quarter 3. Therefore, my request is sequentially, the measure will always look worse in quarter 3 pan industry than quarter 2. So you may want to please consider that as you look to do your analysis.
Sure. Sorry, the corrective actions that you mentioned.
Sorry, the corrective actions, I will request my colleague Arjun to.
Sure. Thanks, Puneet. So as Puneet mentioned, there are a few segments where we were seeing signs of stress and we were observing them very closely. So the corrective actions are largely focused on those segments. Those include
a whole list of granular items, and I'll give you just a few to give you a flavor of what those entail. They include things like raising the cutoffs in terms of whom we onboard in certain segments. They include raising the income cutoffs. They include things like orienting our acquisitions towards a certain segment of customers where we believe there is a greater durability, looking more closely at the overall degree of leverage which a customer has in the system. As you know, there is a degree of over-indebtedness which we have seen, so building measures to look at that. So those are a whole host of corrective actions which we have taken. And this is not just something we've done in this quarter. We've been doing that over a slightly longer, not slightly, over a materially longer period of time.
All right. Thank you so much.
Thank you. We'll take the next question from the line of Ashish Agashi from PTI. Please go ahead.
Thank you so much, sir. Hope I'm audible. Just a small thing. You're saying that, okay, there has been a degree of indebtedness which you see in the system. You have been taking corrective actions due to which credit growth is a bit soft, which is a deliberate measure. These are macro factors as well. So as you look at the market, by when do you see things sort of gaining some speed given where we are right now? And also related to this, I also see that the personal loans are up 17% YOY, credit cards are up 8%. I can understand that, okay, the comparable YOY, the growth would be much more higher, but even if I look 17% in isolation, isn't that a bit high for a portfolio where deliberate actions are being taken to slow down?
It's difficult to predict where we are in the cycle at this point in time, largely because the external macros are fairly dynamic at this moment, and we continue to look at them, we continue to monitor them closely, but the liquidity continues to be tight. Global macros, especially geopolitical risks, continue to be somewhat undefined at this point in time. Hopefully in the next 30 to 45 days we'll get better clarity around that. Some of the India growth also has been a bit tepid in the last quarter. So difficult to say, when do we see this coming back to normal. We look at our portfolio quite closely. We take our actions based on that. And then we closely monitor what the external world looks like to see where do we go from there. So that's in terms of how we see, where we are in this cycle. On the specific growth numbers in certain sectors, see, that's based on our understanding of the sector, what we are hearing from our customers, from our people on the field, and the way the portfolio is behaving at any point in time. And we have multiple early warning indicators of various portfolios. So based on that, there are certain segments which are growing at 17%, which we are fairly comfortable with because we know how that portfolio is faring. We are quite close to our customers. We understand how their businesses are faring. And based on that, we have a decision that we take in terms of where to possibly accelerate and where to hold back a bit. So that happens on a fairly dynamic basis. And we continue to monitor the overall portfolio mix and the growth within that based on those inputs that we receive.
Okay, sir. A small second question, sir. I do understand that you don't give a sort of a granular breakdown into what the gross slippages number are. But sir, if I were to say that 4,923 crore of retail gross slippages, a majority of them came from unsecured exposures. Would that be a correct understanding, or would I be just missing the point because there is a big part of agri playing there?
So that conclusion would have been fair for the last quarter. In the current quarter, it's a mix of unsecured portfolio plus seasonality on Bharat Banking that has played through in the current quarter. Let me also clarify and put out data since we don't give you slippages, but let me contextualize MFI slippages for you differently. Our total retail loan book is roughly 6 lakh crores. Our retail MFI book is approximately 1% of the total retail loan book. So that puts it at roughly 6,000 crores. If you contextualize 6,000 crores in the context of my total advances, it's about 0.6, 0.7%. So you could derive comfort from the fact that that book is inconsequential in size compared to my total loan book. So our book is very different from some of the other peer banks you may be used to looking at from an MFI space perspective.
Thank you so much, sir.
Thank you. We'll take the next question from the line of Piyush Shukla from the Hindu Business Line. Please go ahead.
Yeah. Good evening, sir. Puneet sir, wanted to understand why is there a sharp drop in the other income, in this current quarter as against the last quarter? And separately, I wanted to understand the LCR, draft norms from April and onwards. Have you done an assessment as to what would be the impact on our books? And have you also, communicated with the regulator with regard to the 5% runoff factor, which is their additional 5% for internet mobile banking related deposits? So is there any communication in that regard and assessment on the LCR front? If you could lastly just allow me to ask one more query on your NIM. You had said due to specific issues, 6 bits it has fallen sequentially. So if you could, I understand you don't give any particular guidance number as such, but the trajectory from here on, will it be stable or do you expect slight more moderation going ahead? That is all. Thanks.
Thank you for all of your questions. Please allow me to address them individually. Your first question was what has caused the other income to drop? Other income comprises fee income and trading income. Our fee income has effectively been flat quarter on quarter. So we've continued to do well on fee income. Our fee to assets remains the healthiest amongst industry at 1.42%. It's actually, if not best in class, very near best in class. It was so last quarter, it continues to remain this quarter. The drop in other income has come on the trading line. And in the trading line, if you would recollect, RBI had issued a circular on April 1, which required us to mark to market all investments. So we had a mark to market gain last quarter. That mark to market gain, given the current volatility in the economy and key macro variables, has reversed in the current quarter. So the entire differential in other income can be attributed to broadly reversal of MTM gains booked last quarter with a reversal in the current quarter. Given the regulation around accounting for investments, this volatility is likely to pay through in subsequent quarters, both on the positive and the negative side. Your second question was around the prospective LCR guidelines. We've done an internal assessment. We don't discuss it publicly. The guidelines are still in draft stage. I think the entire system has represented to our principal regulator for review. So we will wait for the final guidelines before we can make a constructive comment on its impact. I think your third question was on margin outlook. We've consistently stated that we don't provide short-term guidance. Our margin outlook is as follows. On a through cycle basis, the bank will operate at 3.80% net interest margin. As of last reported quarter, which is Q3FY25, we have a 13 basis points cushion above our through cycle guidance. We intend to work very hard to retain as much of this cushion as we possibly can. I hope I've covered all your questions. Thank you.
Yes, sir. Thank you.
Thank you. The next question is from the line of Shubhra from Informist Media. Please go ahead.
Hi, sir. Am I audible?
Yes, ma'am. Please proceed.
Hi, sir. I have two questions. First was with respect to your loan book mix. Just wanted to understand on a quarterly basis, your retail portfolio has grown by just 1%. So is that something that you will be kind of reducing and increasing the other books, or what is your assessment on that? Firstly, this. Then I'll ask the next question.
Thank you for your question. Our loan books mix has been relatively stable. Our mix last quarter was roughly 60% retail, 11% SME, and 29% wholesale. That mix continues in the current quarter. So we've had a stable mix. The growth in the retail portfolio is reflective of the headline growth that we've had. So we've had no mix change from a business plan perspective.
Okay, sir. And also with there is an expectation of rate cuts also in February. So any impact on your margins? Anything you would anything on that?
I mean, our internal, economist team do not share that view. We believe that we might not see a rate cut that soon in the cycle. And if there is a rate cut, we will accordingly take action on both sides of the balance sheet. So too early to, give a view on what happens if there is a rate cut at this time.
Sure, sir. Thank you so much.
Thank you. We'll take the next question from the line of Ritu Singh from CNBC. Please go ahead.
If I'm audible, just a couple of questions. First, clarification on this margin bit. You said you'll take action on both sides of the balance sheet. Are you indicating that, when RBI starts to cut rates, you'll reduce your deposit rates? How will you protect that 13 basis point or so buffer that you spoke about, that you currently have on margins that you wish to maintain? Secondly, on your slippages, would it be possible for you to quantify how much exactly has come from agriculture? And also maybe more than numbers, Mr. Chaudhary, if you could give a broader comment on, how many of these smaller customers that, may be defaulting on these unsecured loans have secured loans with the bank as well? Because, once they start to default in the smallest of amounts, that borrower gets tagged a defaulter and therefore affects the larger loans they may have as well. So, what is the sort of linkage you're seeing? Are you concerned on that front?
I'll take the first one, please. So Ritu, as Subrat mentioned, in an environment where we have a depreciating rupee and liquidity continues to be tight, it looks unlikely that we will get a rate cut anytime soon. But having said that, the way that this will work out is, given the fact that a larger portion of the asset book is now priced against external benchmarks, yes, if a rate cut does happen, the first repricing that will happen is on the asset side. But over a period of time, the liability side will also reprice. Maybe there's a bit of a lead and lag depending upon where we are on the cycle. But ultimately, both sides of the balance sheet will reprice if the rate cut happens.
On the unsecured slippages leading into slippages in other secured loans as well?
Sorry, I couldn't hear what you last mentioned. You said on unsecured slippages, and I lost the audio after that. Could you repeat that, please?
So essentially, if the same borrower that has a smaller loan has defaulted and gets tagged as a defaulter, to what extent that will affect other secured loans he may have, other larger loans. So, how many such borrowers do you have? What kind of...
So policy-wise, understood. Thank you. So policy-wise, the requirement is very clear that the NPA status is classified at a borrower level. That has been our position, and that is the position across the industry as well. Now, in terms of how many borrowers who have smaller versus larger, that is something we wouldn't put out in terms of granular data. But I'll request Puneet to add more to it.
Thanks, Arjun. In the interest of addressing this question explicitly, For the quarter, 29% of our gross slippages are attributed to linked accounts of borrowers, which were standard when classified or have been upgraded during the quarter. So that should give you a context of how much of the gross slippage could be on linked accounts or on borrowers that were upgraded intra-quarter.
Okay, this question was actually more on whether these borrowers that have unsecured loans also have secured loans with the bank, and therefore will those also get downgraded?
Thank you for the question. I think, Ritu, what we're trying to address for you is, if I, let's say, have a credit card which went bad, and I also have a home loan, one, the home loan could continue to be serviced even if the customer on the credit card has gone bad. So the way we understood your question is to understand linkages. So if you look at the cumulative slippages for the quarter which we've called out, which is 5,432 crores, 29% of the gross slippages for the quarter are attributable to the linkage that I have just described, or accounts that slipped and got upgraded in the same quarter. This 29% has broadly been a flat number for multiple quarters. So this number ranges from about 29% to 33-34% on a quarter-by-quarter basis. So what we're trying to address for you is, if a unsecured slipped, there could be a secured slippage which continues to remain standard, and we've quantified that number for you. So that should give you a flavor of quality of slippage that we have.
Yeah, that explains it. Thank you. Thanks very much.
Thank you. A reminder to all the participants that you may please press star and one to ask questions. The next question is from the line of Piyush Shukla from the Hindu Business Line. Please go ahead. Mr. Shukla, I have unmuted your line. Please proceed.
Sorry, am I audible?
Yes, sir, you're audible. Please proceed.
Yes. Puneet, sir, just to follow back on the earlier question about NIM that I had asked, and you had said that 13 bips cushion is still there. So are you hinting that the NIM margin may continue to moderate in Q4 as well? And separately, sir, I don't see SMAs, what is the breakup or the overall SMAs that you have. If you could just give us some color as to what is the quantum of special mention accounts that you have across buckets, and is there a rise in the comparative, corresponding quarter last year and just last quarter? Some data on the potential slippages, stressed accounts, if you could give me any, and what are the segments that these SMA loans are coming out of?
Thank you for the question. I think we do have an exhaustive list of disclosures as part of our investor presentation. Unfortunately, we do not disclose the SMA profile of our book, either historical or current. We haven't put that data in public domain ever, so therefore I'm unable to answer that question for the purposes of the call. If I paraphrase your first question for my understanding, your first question was our margin outlook and what do we think margins will be, whether margins have reached trough or are likely to fall further.
Yes.
Is that a fair paraphrasing of your question?
Yes, sir, because you had mentioned there is still 13 basis points sort of a, cushion that you have in terms of the historical average which has been there. So basically, do you expect it to fall more, the margins from here?
So like I said, I think 380 is our through cycle guidance. We are comfortable retaining that through cycle guidance even in the current macro environment. The 13 basis points cushion we will defend as hard as we possibly can. We do not provide a quarterly outlook on where the margin would be. The one comfort I can give you is basis historical performance. If you look at FY23, where only assets got repriced, we delivered a full year margin of 402. In FY24, where only liabilities repriced, we delivered a margin of 407. So my request is, as you think of margins for a financial institution our size, please do not think about margins on a sequential quarter basis or running quarter basis. We are delivering to a finite period of time. We have a reasonably closely matched duration of assets and liabilities to the point Rajiv made earlier on the call. Therefore, our comfort that when a rate cut comes, over a finite period of time, we'd be able to balance asset repricing and liability repricing.
Okay. Okay. If I could add one question to Amitabh, sir. Your number 4 private bank in terms of profitability has went on record and said that they aim to be number 3 in terms of overall profits by FY30. So, and Amitabh sir also spoke about, going through and sticking to the expansion and growth plans going ahead. So how do you, aim to maintain the number 3 stand that you have in terms of profit amongst all the private banks?
Wasn't delighted to inform you we're already number 3. So in terms of private banks. So I don't know where you're getting the 4th from, but first.
No. The 4th person saying they want to become number 3, sir.
Cool. Sir, that way every bank wants to move. Sorry, I misheard you. Every bank wants to move positions. We have been obviously very focused on ensuring that in kind of overall scheme of things we do move up. There is a clear gap between us and the 2 banks we keep talking about internally. We have to be focused on people ahead of us. Yes, we are very cognizant of what Kotak's ambitions are. But we believe that if we can keep executing on the strategy which we have laid out and some of the things that we talked about in this call, we have a great platform, great set of people. We have worked hard on our technology, which is one of the best in the industry. We have a very strong balance sheet and capital ratios. I think the amount of work we've been doing on the deposit and the advances side, on the asset quality side, puts us at par with some of the players we're competing with. We just need to keep executing better, and we are quite confident that if we keep focused on execution, the numbers will come. They will take time, but they will come, and that's what the management team is focused on.
Thank you very much, sir. Ladies and gentlemen, we will take that as the last question for today. I would now like to hand the conference over to Mr. Puneet Sharma for closing comments. Thank you, and over to you, sir.
Thank you so much for taking time to speak with us this evening. If we've unfortunately not been able to answer your questions, please feel free to reach out to Piali and her team at Corporate Communications. We'd be happy to pick them up and respond to them. Wishing you all a very good evening. Thank you.
Thank you, members of the management. On behalf of Axis Bank, thank you for joining us, and you may now disconnect your lines. Thank you.